Good morning and welcome to Options Brew TV. I'm your host, Lex, and we've got some interesting topics today. As we're bracing down for a winter storm in the Midwest, we're supposed to get a lot of snow today. But let's check it out today on Options Brew Traders Workshop. Hello, Jason. How are you? Look at you cracking up already.
What's going on, Lex?
Oh, not much. The same old thing. So today we're going to briefly talk, the show will be a little bit shorter today, but we're going to talk about synthetics with options. Okay. So first let me explain. This is something maybe you didn't come from the trading world down on the floor, but you will understand these things. On the floor for us, understanding synthetics was very important. Okay. And it was probably more important when we didn't have computers and we didn't have theoretical values, and some genius on the floor figure out the relationship of calls and puts to one another. So it became interesting because calls and puts were mispriced in the beginning of time on the floor. And when this gentleman figured this out, he was able to make arbitrage and totally lock in profits without taking virtually any risk. Okay. And then we're going to show some of that. I'm going to share my screen and we're going to talk about some of that.
Who's that gentleman?
Oh,
obviously wasn't you, but
it wasn't me. I was too young. I was still in the womb, I think, when they figured this out. But his name was Dick Handelsman. He's no longer with us. He passed away several years ago. But he was just brilliant at figuring this out. So you can imagine standing in a trading pit, looking at the screen, going, "Wait a minute, something's not right here. This isn't making sense to me." So I'm going to show the folks what some of this means and why it has to be this way. Sound good?
Yes.
All right, let me share my screen. Okay, here we go. So we got TradeHawk up here. So Jason, you've heard of synthetic long stock before, is that right?
Yes.
Okay.
That would be a long call and a short put on the same strike.
Correct. So when you have synthetic long stock, so I'm going to just build it right here. So I'm going to put my long call in, and I'm using the 90 strike in Google. Okay.
Okay.
And I'm putting my short put in. So this trade has 100 deltas. Now it could be 103 or 104 with interest rates and or dividends thrown in, but let's for clarity's sake call it 100 deltas. So it's the sum of the absolute values of the deltas. Okay. So if I'm buying a call and selling a put, I'm getting long deltas on both of those. When I'm using the same strike, right, it's going to sum to 100. My short delta put, okay, is a negative put delta times a short is going to give me a positive delta. The long delta call, my long delta times the positive delta is going to give me a positive as well. So this graph should look like a 45-degree angle of the position. It should look like that, right? That is stock. Okay. Now, what's interesting about this is long stock. Now, short stock is if you invert it, sell the call, buy the put, and it would be the opposite way. It would look like short stock. Why does this mean anything? Okay. Well, what this gentleman figured out is the relationship of that combo, or whatever you call it, spread, has to be related to the underlying stock price. Okay. Now, unfortunately, I'm in a paper trading account right now, and it's delayed a little bit, so the numbers might be off a little bit. But if you look at this pricing, okay, and you can see I've got a price of 35 cents, okay, on the 90 line. So what you would do is, it's a credit too. Sorry, you can see the credit. You take the strike price and you add that credit into it. So it's actually in a credit, it's subtracting, right? So it's going to be 90 minus the 35 cents, right? And let's see what that comes out to be. 90 minus 0.35 is 89.65. That's the synthetic price you're buying this stock at. Does that make sense so far?
Yes.
Okay. Now, look at the real stock. Now, unfortunately, the real stock isn't in trading, so these values will get a lot closer when it opens up here. The real stock is 89.58. Remember, I'm buying synthetically 89.65, and it's actually trading at 89.58. Okay. Now, again, paper trading count, the numbers are going to be a little off. So what this gentleman figured out is when you do this calculation of creating synthetic long stock, okay, it has to mirror the actual stock. Otherwise, there's an arb. You could buy this combo, sell the stock, and lock in any difference.
Right.
Does that make sense?
Totally.
Okay.
Yes.
So if I were able to buy synthetic stock for 89.40, let's say, and I'm making that number up, and it's really
Mhm.
trading 89.58, I'm going to make 18 cents every time I do that spread. So when I do
Right.
it one time, okay, that requires 100 shares of stock, right? So one by one on the options, 100 shares of stock. So what he started doing is he started making these reversals out of this thing, and he kept buying that combo and then selling the actual stock. And he made the difference when there was a difference. And they were
Okay.
significant differences. They were sometimes dollars off. And he kept his secret to himself, and no one knew what was going on with this stuff. Okay. So
Wow.
it's amazing how these synthetics worked. Now they exist in other places, and maybe they're not, synthetics is a bad word,
I
but
have questions.
yeah, please go ahead.
Okay. Is it possible that nowadays, especially since it's pennies or whatever, the synthetic can be the risk-free rate, like whatever risk-free rate that people are calculating in,
Mhm.
and that the differences between, if I were to buy that long and do that same kind of arbitrage, it could just be a difference of whose risk-free rate we're using.
Yep, it's a great question. So the answer to that is when you compute these things, when you do the synthetic versus the stock, there is an interest rate component involved, right?
Yes.
And the interest rate component has to do with this risk-free rate. So at every clearing firm where people have positions, okay, they are charged for long stock and they should be getting credits for short stock.
Hmm.
Okay. So if you generate a long combo in this example and you have to sell stock, you're going to receive that risk-free interest rate on your short stock. That's going to be a credit to you in 30 days. They pay it out in 30 days. Okay. So it's
Right.
going to accumulate some sort of interest. So naturally, if you're buying the synthetic stock low, or then you're selling the short, I'm sorry, you're buying a synthetic stock higher than the short stock, the interest rate's going to whack that back into line. So it's not going to
Hmm.
be exact. So whatever that interest rate, let's say it's 10 cents. Again, I'm making that up. So you would pay 10 cents higher for the combo, the synthetic, and sell the stock 10 cents lower because at the end of the month or the end of the expiration term, that
Yeah.
10 cents would come back to you in interest and you'd be at net zero. So it's exactly right. You can work backwards with all the math and figure out what risk-free interest rates market makers are using to price this stuff as well. That's exactly right.
Yeah.
Okay. Good.
So that's like a road trade.
Yeah. So
That's a
okay, for the retail folks, you're not going to make this trade because it doesn't exist anymore. Okay. But what's important to
well.
understand is what the relationship is. Okay. And
Well,
why it's there. Go ahead.
here's another thing, Lex, to think about, because I've actually been looking at this a little bit on more of like a safety kind of thing.
Yep.
Um, if you go look at like higher dividend yielding stocks right
Hmm.
now, I mean, you could. I've looked at a couple. I mean, some of them they work and some of them they don't.
Yep.
But I mean, even if you look at Verizon, which has had rising dividends over the past couple, over the past several years, and they're very cash rich. And you notice that if you were to do this synthetic short for a year time period,
Hmm.
and you were to go long the stock, you're supposed to be paying a year's worth of dividends plus risk-free rate,
Right.
but it only comes out to be about a quarter's worth of dividends. And obviously there's some risk-free rate in there, but it comes out to be a little bit more than a quarter's worth of dividends. So if you have a stable dividend stock, I mean, that might, in the high interest rate environment we're in now,
Hmm.
it might be not too bad.
Yeah, no, absolutely. And that, you made a good point about dividends. Don't forget when you do, God, the market's down 306. Just feels like nothing from yesterday, right? Um,
306.
yeah, I'm just looking now. Nasdaq's down 185. So we give everything
Oh,
back practically what we did yesterday. It's just amazing how this flips around every day. So volatility, your friend. Um, yeah. So the other thing about the dividends, if you're short stock, you'll pay those dividends. That's got to be a
hmm,
part of your calculation if you hold this position through a dividend, right? If
yeah,
the dividend is a month from now and your expiry is in front of that, you're not going to pay the dividend
yeah,
because this
that
thing
doesn't
will
matter.
expire, um, before the dividend happens. Now, here's the other thing to know: no matter where this stock goes at expiration, you're going to be out of it for zero, except for one spot. Okay. Think about it. I'm doing the 90 strike, right? That's my
Mhm.
strike price. If the stock closes at 95, my put is worthless. My call is worth $5.
Yep.
I'm short 100 shares against this one lot of calls, long calls. They net
Yep.
out. So
Yep.
when it gets exercised, I get 100 shares. It goes against my short 100, disappears. My put's worthless. It goes away.
Yep.
Let's look at the downside. $85. It goes out. My call's worthless. Zero.
Yep.
Nothing happens. I'm short a put. That is the stock's being put to me. The short. I'm getting 100 long shares. What do I have in my position? Short 100. They net out to zero. The position goes away.
Yep.
Okay. So these conversions, it's called a reversal, by the way, but the other opposite is a conversion. Conversions and reversals net out to zero at expiration. However, what happens if the stock closes at 90?
No, you're gonna end up with the shares.
How do you know? So
Because
you have control of one of them. You have control of the long. You can exercise at 90. You
Yeah.
don't have control of the short. You don't know necessarily if you're going to get assigned on the short. So what people did in my business when we were on the floor, when it got pinned right at 90, is they would do a box. Okay. Now let's think about a box real quick and we'll end it there. I already see it's 850. Okay. So remember my position. I'm long the 90 call. I'm short the 90 put, and the stock's closing at 90 on expiration. I'm scared about my short put because I don't know what's going to happen. So do I exercise 50 of my call or half of a call? Can't exercise half of a call. I either exercise one or none in this example. So if I exercise my call and I get assigned, I'm going to be long an extra 100 shares, right? So that's no good. I don't want to come in Monday morning with long an extra 100 shares. So what we would do is we do a box, okay? So remember, I've got the long put. I'm sorry, the long call on the 90 line. I'm short put on the 90 line, right?
Right.
So what I would do is,
Are you sharing your screen?
oh no, I'm not. You're right. Okay, hang on. Good point.
I mean, I know I can visualize it, but I don't know if everybody
what
can.
am I saying? So what we would do is we take this 9 and we'd roll it up. Okay. So what we'd end up doing is we would sell this call out. Okay, that's the 90. We'd close it. So we'd close this position. We would buy in our short put, and then we'd roll it up to another strike and do the long synthetic on the other strike. So let's just take the 93. So what this would look like, and I'm just going to invert this to show you. So this is the opposite of what I'm doing down here. So I'm closing this, and I'm doing the 90. This is doing the 92. It looks like it would be better. 92 long call, 92 short put. So this would be closing, by the way. This would say sell to close. I don't really have this position on. That's why it's not doing it right.
Yeah, no, it's fine.
Oops, what did I do? Oh, it's not letting me do it because it doesn't.
You don't have a position on.
It automatically does it. But these first two are closing. So I'm taking my existing position that's expiring at the strike, closing it, and moving it up 3 strikes or 2 strikes in this example. I don't have issues at the 92 level because the put is in the money by $2. So all I've done is move that synthetic up, and it's a box that you do. So the box is equal to the difference of the strikes. If it's a $2 box, the sum of all those legs has to be around $2.
Right.
Okay. So that's what it needs to be. Now notice what our price is. It's 198 midpoint. Is that close to $2? You better believe
darn.
It's pretty darn close. And we're at Thursday, so that's why it's a couple pennies off. So any box you pick is going to be around the price, okay, of the strike difference. So I'm just doing one now real quickly. And I'll show you what it is and we'll talk it out. Okay. So what do I have here? I've got a $4 box. Okay. So the price is $4.25 and it's in the money. Again, these are delayed quotes, but $4 is where this thing needs to be. Okay. Yeah. And you could always do these things. Another thing that this guy figured out, if I do the box, what is a box? It's buying a synthetic on one strike, long synthetic stock, and selling the synthetic on another strike. Okay, so I'm buying stock on one line and I'm selling stock on another line. And the sum of those two have to be equal to the strike difference. Otherwise, there's an arbitrage. Yes. Right? So what he figured out is I'm going to buy this synthetic stock, I'm going to sell it, and it's $3 strike difference, and it's trading at $2.75. How can it be $2.75 when it's going to go out at $3 every expiration? So he started doing this over and over again. He's making $25 every time he did it. He's doing thousands of times, as many times as people would let him do it. No one knew what he's doing.
Yeah.
It was amazing. And then once computers came along, we figured it out. But
Yeah.
I see it's getting late, but I want people to understand that that's how these market makers think. And now we have machines and we have, theoretical values that do this. But these synthetics are very important to understand, so that when you're looking at something, you can figure out what it is you're doing synthetically. Because if you take any two components of a reversal or conversion, you'll get the other side. Okay. And real quickly, we'll close here. If you remember, you've got, let me get rid of these other two. So where's my put? Let's get rid of that and get rid of that. Now I got to, oops, sorry. Okay. So if you have long call, short put, and short stock, if you combine the long call and the short stock, that is a synthetic long put. What do I have on the other side? A real short put. So the math has to be equal there. We'll talk about the math on another show. If I take and put my short stock with my short put, synthetically, the short put and the short stock is a short call. Okay.
Yeah.
We can show that on a graph. What do I have on the other side? A long call. So that means that arbitrage has to exist as well. And then when I take my long call and my short put, that's synthetic long stock. What do I have on the other side? I got real short stock. They all line up three ways. Okay.
I have a question then.
Yep. Fire away.
So does that mean if somebody actually, somebody speculative comes in and slams on like an $85 or $83 put or something like that on Google?
Yep.
And but you notice that the price doesn't move a ton. Is that because of the static nature of all these relationships have to exist?
Yeah. So yes, that's true. But the market makers aren't going to take endless pounding of calls, right? So or puts for that matter. If an option gets deflated or expands, what has to happen? It's got to pull up the corresponding call. Okay.
Right.
Because that relationship can't get out of whack. Then what happens? You can't have the box get out of whack. Every box. So now you got to pull up the whole term structure in the skew. So everything has to move in unison. Otherwise, all the relationships that we just talked about will get out of whack, and computers will start taking advantage of the mispricings.
Yeah.
So one little ripple like that in an option chain can cause an enormous amount of change and implied volatility movements across the board, right?
Wow.
Because these relationships have to exist. And it gets even more interesting. We'll do this again on another show when you go out in time. So now you've got time spread stuff where you can have a synthetic in one and the opposite synthetic in another month. And you have to work on the time difference in terms of that risk-free interest rate now, right? So we'll talk about that next time, and they can all be offset. So that's how things start getting related to one another on the option chain. And there's lots of expirations, and they all have to be, lined together. Otherwise, there's arbitrage across the board.
All right.
Crazy stuff, right?
Well, no, it's great because, I mean, like most viewers know, I deal with I try to deal with a lot of kind of dealer positioning things. And it's very interesting to A, understand the mind of what the dealers are looking at, and B, understand why these relationships exist, why I can't buy 10 million of this one SPX and then see that one little adjustment of IV or something like that, why the price doesn't even change. It can't change.
Right. It can't. So yeah. Like I said, it's a massive rippling effect when someone picks on one spot, it's going to affect all the spots because of what we just talked about. Cool.
Yep.
All right, man. Good seeing you. I know we have to go. It's getting late. Merry Christmas. Happy New Year.
Merry Christmas.
I think we're off next week because of the holiday. But we'll take it up after the new year, and I'm sure I'll talk to you along the way. So
all right.
Have a
gas
great
up that snowblower.
I know it's coming, man. That's what they say. All right. Rock on.
Take it easy, Lex.
Bye.